If you want to take a trade in a market based upon engulf pattern, this video is for you. Today we are going to understand bullish and bearish engulfing, not as a pattern to memorize, but as a psychology to understand. We'll use real market data and I will draw directly on a chart so you can see exactly how I think. If you have not watched the earlier video in the playlist, I strongly recommend watch them first. In those videos, I have explained what a candlestick really represents and the psychology behind bodies and wicks. That foundation will make today's explanation much easier. Now let's start with something most videos completely skip. Before we talk about bullish or bearish engulfing, we need to understand one simple word, engulf. The word engulf means to completely cover. In terms of candlestick, it means the body of the current candle completely covers the body of the previous candle. Did you notice something important? Engulfing does not mean the wick must be covered. It is the body which matters, the open and close. When a candle engulfs another, one side did not just close the other. They erase the previous decision as well. Now, you have understand what engulfing really means. Before looking at any engulfing candle, we must ask one question. What was the market before the candle appeared? When price is falling, sellers are in control. That selling pressure must exist first. A reversal candle without a pressure is just a candle. Now let's look at the bullish engulfing pattern. Before I explain this candle, look at the chart and describe what buyers and sellers did. If you see, first, sellers were in control. Price was moving down. Then green candle appeared. Buyers did not just stop the fall, they overpowered the seller. They pushed the price above the candle's open and close. This tells us control shifted. This does not mean price must go up. It only means seller lost control in this moment. Market does not reverse because of pattern. They reverse because of one-sided give up. Before taking any trade in engulf, let's talk about stop loss. A stop loss is not there to protect money. It is there to tell you if your idea was wrong, then exit with trade with a small loss. For a bullish engulfing, if price goes below the low, buyers failed. The story changed and we exit the trade without emotion. A good trade is not one that makes money. It is one that losses small when wrong. In a bullish engulfing, we are saying the buyers took the control. If buyers are truly in control, price should not go below the lowest point of the engulfing candle, right? So for a bullish engulfing, the stop loss is placed at the lowest low of the candle that form the patterns. This level acts as a support for our trade. If price break the level, buyers failed and our idea is invalid. Similarly, in a bearish engulfing, we are saying the sellers took control. If sellers are truly in control, price should not go above the highest point of the engulfing candles. So, for a bearish engulfing, the stop loss is placed at the highest point of the candle that formed from the bearish engulfing. This level acts as a resistance for our trade. If price break the level, sellers failed and the idea is wrong. A stop loss is not about avoiding loss. It is about accepting when your reading of the market is wrong. Now, here is a small task for you. On your screen, you will see a few engulfing patterns. Your task is to identify the support and resistance level for each pattern. Write your answer in the comment. I will reply and tell you whether your level is correct or not. Now take a look at some of the real life example where you can trade bullish engulfing. I have a chart of National Aluminium. You can see here there is a small downside movement and a clear bullish engulfing. As this is a downside movement is very small, so you can trade with risk reward of 1:1 or 1:1.5 depending upon your risk appetite. Similarly, here as well, as I am able to see, there is a downside movement and a clear bullish engulfing. I can enter with 1:1.5 risk reward. You can choose depending upon your risk appetite. I have another example you can see here, a Havells chart. This is a recent last week data. You can see here there is a clear downtrend and a bullish engulfing pattern as this is a 4 to 5 days downside movement. So you can trade with 1:2 risk reward favorable or 1:3 based upon your risk appetite, or you can start with 1:1 and trail your stop loss. Similarly, for this chart, if you will see, there is a long downside movement. After long downside movement, there is a clear indication of bullish engulfing pattern. So we can go with a trade of 1:2 risk reward or 1:3. Generally, I go with 1:1.5 and trail my stop loss. Now take a look at bearish engulfing pattern through real world chart. This is a chart of Hindustan Petroleum. If you can see here, there is a clear uptrend movement, and as you can see, there is a bearish engulfing pattern appeared here on this candle. So you can go for a short with 1:2 or 1:3 risk reward ratio based upon your risk appetite. Let's go with another example. This is a Reliance chart. This is last week data which appeared. If you see here, for the last 3 days, it was in an uptrend, and bearish engulfing pattern appeared here. So you can take a trade of short with 1:1.5 or 1:1.2, depending upon the risk reward. Or as the upward moment is not so high, so you can go with 1:1 and trail your stop loss. Now I have a task for you. On this chart, there are multiple bullish engulfing and bearish engulfing. Pause for a moment, and can you identify by looking into the chart, is there how many bullish engulfing and bearish engulfing you can identify here? This is a ICICI chart. Let's see. At this point, after a long downside movement, we saw here there is a bullish engulfing. Similarly, after 10 to 12 days upside movement, we saw here a bearish engulfing. Similarly, after a long downside movement, here you can see again a bullish engulfing. And here as well, after a small downside movement, again a bullish engulfing. Here is a 3 golden rule to make engulfing more favorable. First, engulfing works best at support and resistance. Second, the stronger the prior move, the more meaningful the shift. Third, big candle body means conviction. There are few beginners' mistakes which you can avoid. Most beginners lose money because they try to trade every engulfing. They ignore trends, ignore levels, ignore risk, expect instant reversal. They treat candle as a signal. Professionals treat candle as a evidence. Bullish or bearish engulfing is not the point. The shift in control is the point. Candlestick does not predict the market. They reveals the behavior, and behavior is all we ever trade. If this helped you to understand Candlestick better, like the video, subscribe, and watch the rest of the playlist for complete foundation.